We've had a perfect score until last week when rating company Moody's lowered the score for the U.S. And in the studio today to tell us what this means and how this could impact us is Micah Tipton with Evans Financial. So thank you for coming in and sharing your expertise. Just first, could you explain what goes into creating a credit rating or determining a credit rating?
Yeah, they're looking at things like what is our ability to pay back the debt that we owe? How are we spending money? What are we going to do to ensure that that money is paid back? And within our power, what can the U.S. do as far as taxes or the federal budgets? All of those things factor into what Moody's was looking at when they decided to lower that rating.
Yeah, absolutely. And is this a score that's like a number score, or is it more so a category of perfect versus on the way down?
Yeah, so there's different ways to look at it, and there's more than one credit rating company. Moody's is just the latest to give us a notch down, and we were at a AAA is how they rate it. And the next one down where we're at now, as of Friday, it's a AA1. So we went from perfect to excellent, but it's still significant that they finally did it. And for a little context, they were the third rating company since 2011 to actually knock us down a rating. So.
And how did this happened last Friday? How did the markets respond after that?
Yeah, it looked pretty resilient. We've seen a little bit of a downtick today, but I think overall most investors realize that this is something that did happen overnight. Nobody went and flipped a switch. This has been a long time coming based on how the U.S. has been budgeting and spending money and just how high the national debt has begun to climb.
Right. So for someone who's watching at home right now, maybe they're not as savvy on the investing market, what should they be aware of, or what's really the key takeaway here for them?
Yeah, I think a long-term perspective is probably best. Don't make any knee-jerk investment decisions based on this, but we're looking at the potential for higher interest rates for consumers. If the government is paying more interest on the debt that they owe, that can trickle down to us. And also, if this credit rating downgrade weakens the dollar, then that means that we could see higher consumer prices as well in the future.
Okay, so in connection with the rest of the global market. With the dollar value.
Yeah. Obviously, a strong dollar is good for us. So anything that's weakening that can trickle down to us, and it means it costs more of our hard-earned dollars to pay for those things.
Right. And you said that this didn't happen overnight, or the changes that led to this didn't happen overnight. What does it take to go back up a notch?
I think we would have to kind of turn the other direction with the national debt. It's over $36 trillion. So being able to create a federal budget that has a surplus instead of a deficit, therefore beginning to pay that debt down, that'd be a good signal to these credit rating companies that we're going in a better direction than we have been the last few decades.
So no overnight changes at this point that got us here, and it'll take some time to get back up in the rating.
For sure. This is a long-term issue that Congress really needs to hopefully get some positive direction with.
Absolutely. Well, thank you so much for sharing your insight with us and with our viewers to kind of navigate this for everybody.
Thanks for having me.
Of course. Still to come on KSLA News.